Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just an hour to go until the closing bell, and stocks falling here as investors weigh what the latest data and Fed speak mean for rate cuts. Let's welcome in now Jared Blickery joining us to break down the headlines. Jared, what are you seeing in the markets?
Thank you, Josh. Seeing a bit of weakness in tech yet again. This would be 3 out of 4 days, but let's check out the Dow first, down only about 0.25% or 122 points. You can see it started out green, then it shifted into the red. It's just been chopping around. That is a pretty typical December price action for the Dow. Now here's the NASDAQ. It opened up a little bit in the green and is just kind of making new lows as we speak right now. 1.43% is not nothing, so it's something we'll keep an eye on. S&P 500 kind of splitting the difference here. That is down almost 1%, just a tiny bit off of the lows, but for the most part, kind of a weak day here. Also checking on the small caps, and we'll go to the Russell 2000 for that. Very similar chart, started out green, drifted in the red, close to the lows of the day. Not seeing a whole lot of action in the bond market. If we check out the 10-year T-note yield, it is exactly flat, 4.15%. Here's the 30-year. It is up just a fraction of 1 basis point, so almost flat. 4.82%. So not a lot of action there. US dollar index, meanwhile, has been positive all day. It's up about 0.25%. Checking in on the price action. I said tech was weak. There it is. XLK down 1.84%. Industrial is also having a negative day, down about 1.5%. Both of those underperforming the S&P 500. To the upside, we got some bright spots. Energy, which was down 3% yesterday, worst day in months, that has rebounded today. That's up about 2%. Real estate, staples, materials, financials, all of those in the green right now, but only energy up more than 1%. And if we take a look at the NASDAQ 100, we can see kind of an ugly picture here. A lot of the mega caps just not doing well. They were the lone source of strength for the NASDAQ 100 and many of the larger cap index yesterday. But here, NVIDIA down 3.5%, Alphabet a little bit less than that, Tesla down almost 4%. I believe it did notch an intraday record high close to the open, but it is now in negative territory. Broadcom also down about 4%, then AMD down 5%. So I'm going to show you the chipboard real quickly. That is ugly. If I show you the software board, a little bit less ugly there. So we got some green. Microsoft up about 0.5%. But I do want to leave you on the Dow. This is interesting because we actually have more green than red. Nevertheless, the Dow, the index itself, still in the red there. Caterpillar down 4.7%. That's contributing to that big loss that we saw in industrials. But some of the bright spots, we got PG up almost 2%, Chevron up 1.5%, Home Depot over 1%, Salesforce almost 2%, and McDonald's up about 1.2%. Josh.
All right, thank you, Jared. Well, the volatility in tech stocks has my next guest looking for opportunities beyond the mainstream AI winners, and it comes amid an uncertain economic backdrop as the effects of the government shutdown still rippling through the data. Joining me now is Roosevelt Bowman, Bernstein Private Wealth Management Senior Investment Strategist. Roosevelt, it's great to see you on set. Let's start with your economic outlook, Roosevelt. You expect GDP growth here of just 1.5% in 2026. Walk me through that, Roosevelt. What's the big swing factor or factors that could maybe, push that estimate higher or lower next year?
For sure. I think it's the labor market, without a doubt. That's where we're most focused on. When you look at labor demand in particular, it is quite weak. We would agree with, the more dovish accommodative members of the Federal Reserve in really focusing on the labor demand side. And when you look at some of the forward-looking indicators, online job postings, the salaries associated with them, both at 4.5-year lows. Those are well correlated, about 70% correlation with the JOLTS data. So it does give you a little bit of a lead and a peek into the future when you're looking at the government information. And it suggests that there just really isn't strong demand for workers. That means wages eventually come down, consumption comes down as well, and that feeds into our lower growth forecast.
And so what is your view, Roosevelt, of the consumer next year then?
So when we think about the consumer, it's the current situation looks okay, and it's been quite solid, actually kind of produced somewhat of an upside surprise for third quarter GDP. But going forward, that wage pressure that we see across the board is likely to have consumers pull back. And we actually have observed some of this in some of the consumer data, looking through the earnings forecasts and reports of middle and lower income kind of focused companies and focus on those households. they're showing consumers pulling back in both the quantity and quality of what they're buying, and we think that'll continue through 2026.
You mentioned the Fed. Here was Federal Reserve Governor Chris Waller, dovish, right? Roosevelt saying he anticipates cutting interest rates further next year. The labor market's telling you, he says, we should continue cutting the rates. What is the Bernstein base case for how many cuts next year?
Our base case is that they do cut 4 times, so a little bit more
really?
than, yes, absolutely. So a little bit more than what the market's currently pricing. Market pricing is 100% chance.
Even with inflation above target.
Absolutely. I think part of the reason there is that we would probably agree with the Fed's view in terms of inflation on 2 fronts. Number one, you think about inflation being potentially, and right now, higher over the short term, but as that wage growth really slows, then you end up with inflation continue to move lower. The other part of this too is interesting information and research from the San Francisco Fed, looking at 150 years of tariff data and policy in the US, actually shows that unemployment goes up and inflation goes down. That uncertainty weighs not only on business investment decisions, but also on consumer decisions as well. I think that is part of what we would agree with the Fed, that inflation is more of a short-term problem and not a real hurdle towards easing policy throughout the year.
Let's get this bottom line is what this means for investors. You say here, stretched valuations in tech, Roosevelt. Now, is that tech generally? Is that parts of tech, Mag 7, unprofitable AI names? Where are you seeing that?
It's really points 2 and 4 there. So you think about your unprofitable names and some of the more speculative parts of the market. Now, I would argue, and we would argue, that some of that froth has come off when you look at, for instance, quantum computing stocks. They went up in some cases 100%, and they've round tripped, they've come back down. So some of that kind of investor euphoria around the less profitable parts of the market has come off, but you still go back and look at the last 12 months or so, small caps in particular, the companies that are not profitable are still outperforming the profitable ones by almost 2 to 1. That's not a condition that's going to hold. And so for us, we're thinking about some of those stocks where they're utilizing AI, taking advantage of the data that they have. You think about your credit card companies, some of your big box retailers that can improve their sales and distribution or bolster their cybersecurity. Those are really interesting themes to us where we can still invest in AI, but at much more attractive.
Yeah, that was it. You mentioned that. So you do like these credit card companies using AI. Am I excited about that, Roosevelt? Because that's going to significantly impact fraud losses, or it's going to have an impact on cybersecurity? Like, what's the excitement there about?
Absolutely, it's exactly what you touched on, Josh. You think about cybersecurity. I travel a ton doing AI events in particular. 10 years ago, if I'm in Seattle doing an AI event, I'm getting a call from Chase about suspicious activity because I've never been there before. Now they can see the pattern of me visiting some of these cities for the first time, understand kind of what I'm buying. I'm going to hotels, Ubers, et cetera. And you're able to use that data to then say, hey, these transactions are okay. Much more efficient and better customer experience.
You also look at, you touch on big box retailers who are leveraging AI and machine learning. Is that, Roosevelt, because, those are names where AI is going to impact margins, inventory? Is that it?
I think it's that, and also the fact that a lot of those retailers have so much information about their consumers and about their distribution. So you think about using machine learning models for improving your truck routes. You think about using AI to really refine which goods you're selling in which stores in which states. And so the real treasure trove is the information about consumer behavior. That's an expensive input into these models. If you're a large retailer, you have all the information. You don't have to go outside of your business for it. And then if you have, I would say, people that are open to AI in terms of leadership, strong data scientists, and then kind of conduits in the middle, those folks that understand the business but also have strong data science skills, you can come up with some really creative ideas about how to improve your sales and distribution.
Finally, are you all staying U.S. focused, or do you see opportunities overseas?
We do see opportunities overseas. We are cautioning our clients that they should temper expectations about international equities, that if you look at the performance for most of this year, it's been U.S. dollar weakness driven by the policy uncertainty. That has subsided somewhat. So yes, we still like international equities. We've kept it as a part of our allocation, but we do temper expectations going forward. I think in terms of the individual equities, it's a bit of a different story. In Europe, you're looking at kind of the recovery in the banking sector that we've been able to take advantage of. going towards countries like Japan, for instance, where the trade deal is already settled and it's a more stable situation, kind of being underweight countries like China, where, there's still tensions on a trade front with the US. So we are being selective in international equities and again, tempering expectations for dollar weakness going forward.
Roosevelt, a lot of big, important takeaways for viewers. Thanks for your time today. Appreciate it.
Thank you so much.
Well, coming up, we're taking a look at some of the top trending tickers on our Yahoo Finance platform. That is next on Market Domination. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Join me here for a look at GE Vernova, Procter & Gamble, and Gap. We're going to start here with GE Vernova. Those shares taking a hit as it gets weighed down by doubts on the AI boom. So this one we've talked a lot about, Brooke. I mean, it's been seen as a smart AI-related play. The stock's been a rocket ship this year. It's up around 90%, but it is getting hit in today's trade.
Yeah, it's down about 10% in this or late innings of today's trading session. But what you just said is really what I'm hearing from rhetoric on the street. Keep in mind the stock does have 27 buy ratings, about 10 holds and 3 sells on the street, and so largely bullish on this stock. But what we do know is that even earlier this week, Evercore actually initiated their coverage on the stock with an outperform, and they said there are 3 reasons why they're buying this stock. They said growth is strong and well supported by backlog in both power and electrification, margin expanding with operating leverage, pricing and productivity in both those factors as well, and shareholder returns are very well supported. And so to see this sort of take a step back, a backseat during today's trading session definitely speaks to the volumes that this fear around this AI boom definitely has, the implications it has for various other stocks, different than what we typically hear, beyond just the NVIDIA.
Looking at Procter & Gamble, that's another name on our radar today. Jefferies gets bullish on that name as it lifts its buy rating, its rating to a buy. That one, so Jeffrey, they do go to a buy on that one. They like Church & Dwight, by the way, also. On P&G, they say they're entering 2026 on firmer footing.
Yeah, they said firmer footing. They said they have scale and category breadth. They're also creating a strong platform for innovation-led growth as well. Keep in mind this stock largely underperforming year to date. It's down about 12%. Also, when you take a look at where exactly Wall Street, bit of a mixed picture here. There's 16 buy ratings, 12 holds, and 0 sells. And I was reading a note from CFRA, and they did say that their hold rating really reflects this risk reward as Procter & Gamble maintains that 2026 outlook, and also this really promotional environment that's causing market share losses. They too say that they expect P&G to really focus on innovation here to drive volume growth. Also really try to understand where exactly they play within this picture as consumers are really picking and choosing where they want to go in this environment.
Finally, last but not least, Gap getting more love on Wall Street. That stock receiving an upgrade from not just one, but 2 firms, Telsey Advisory and Baird, both upgrading that name to outperform. Baird saying here, turnaround remains in the early to mid stages, momentum behind brand reinvigoration, companies produce margin execution. Most analysts do still like this one. 60% say it's a buy, Brooke.
Yeah, 12 buys, 8 holds on the street right now for Gap. And really, this is a turnaround story for the retailer. Telsey Advisory Group saying that they're seeing improving results and increased margin. Expectations reflect continued progress. Keep in mind, though, we have that Gap, we have that Old Navy brand really outperforming the other brands. Athleta, that's their athleisure brand. And similar to Lululemon, that company hasn't really been doing too well. And so really, that is the work in progress that Gap really needs to focus on here. Telsey Advisory Group acknowledging that in the note, saying that that does remain a work in progress, but new leadership is expected to improve results over time. And so it seems like Wall Street's willing to stick with this one and see where this turnaround goes.
All right. Thank you, Brooke. Appreciate it. We've heard from a few Fed officials today following last week's rate cut. Yahoo Finance senior Fed correspondent Jennifer Schonberger is here with the very latest. Jen, what did we hear today?
Hey there, Josh. As Fed Governor Chris Waller meets with President Trump this afternoon for the position of Fed chair, Waller said earlier today that he sees cutting rates further next year on account of a cooling job market. Speaking at the Yale CEO Summit this morning, Waller said, quote, "The labor market's telling you we should continue cutting rates. We're not seeing a dramatic decline of the labor market going off a cliff, just kind of continuing to soften and soften so we can cut at a moderate pace. Now, Waller said the Fed is about 50 to 100 basis points from a level of neutral on the Fed funds rate. That's a level designed to neither spur nor slow growth. So he says there's still some room for rates to come down further. Now, for his part, Waller acknowledged that inflation does remain above the Fed's 2% target, but he thinks that inflation is going to start coming down over the next 3 to 4 months as tariffs work their way through the economy. And he says that in and of itself is a case to cut rates further. Now, Waller, as I mentioned, is also on President Trump's short list to be the next Federal Reserve chair and is slated to meet with the president this afternoon. Waller said he believes that central bank independence is very important, but that the Fed also has to be accountable to the public. Now, when he was asked how he would respond if the president says that he should have a say in interest rates, Waller said the president very clearly says on Truth Social his views and mentions them in public gatherings. However, in the context of a crisis like COVID, for instance, it would be customary for the Fed chair to get in touch with the president for more of a coordinated response across the government. Now, on the flip side, we also heard from Atlanta Fed President Raphael Bostic, who reiterated for the second day in a row that he does not see cutting rates further at this point. He's more concerned about sticky inflation than the labor market. He thinks that the softness that we're seeing in the labor market is due more to structural issues that monetary policy can't solve. On the other hand, in talking to businesses in his district, he hears they are dealing with higher costs on account of tariffs and that they want to continue to pass those on to consumers. He doesn't see inflation coming back down to the Fed's 2% goal until 2028. Of course, Bostic announced he is expected to step down from that position at the Atlanta Fed at the end of February. Josh?
So, Jen, you mentioned how Waller scheduled to meet with President Trump. What do we think, Jen? Is he going to be the next Fed chair? Is it going to be Chris or no? It could be a Kevin.
It's too tough to call. I mean, the betting markets are still looking at one of the two Kevins, right? The president did meet with Kevin Warsh, last week, whatever the same day of the FOMC meeting was. And he said that he very much liked Warsh, that he's at the top of his list because Warsh sees lower interest rates. The president wants somebody in there who is going to carry out his vision for lower interest rates. Now, it does seem that Chris Waller was setting the stage this morning, saying that he does think that the Fed could keep cutting further. It seems like he sees anywhere from 2 to 4 more cuts next year. And we know the median right now is for just 1 cut next year. So, and Waller was one who President Trump had appointed to the FOMC originally. So that's not to say he's not in the running, but we're really going to have to see how this plays out. I'm not prepared to handicap this. I have to tell you that.
The drama continues. Jen, thank you. Appreciate it.
Thanks.
Well, shares of Hut 8 soaring after signing a $7 billion deal to build a 245 megawatt data center as part of a larger deal with Anthropic. William Blair Group's head of the energy and power technology sector joined opening bid this morning to talk about the companies that are ready to power the AI build-out.
I have a pretty unique and contrarian view than most, which pretty much disagrees with most strategists and economists, which is I actually think that if you believe that the world is moving to a multipolar economic system from a unipolar system that we've enjoyed over the past 80 years, then what that means is that the U.S. is going to have to re-anchor around energy and power, and in particularly power, as your last guest was talking about, for nat gas and electricity generation, of which data centers are a big driver, but they're not the only driver. So as you think about the US, where we've offshored a lot of production, and the attempt to bring back semiconductor fabs like TSMC in Arizona, or steel mills, or shipyards, the things that President Trump has been talking about in terms of foreign reinvestment in the US, all of that is going to require firm baseload. And that is the big shift that's occurring. And there you have coal. That's unpalatable in terms of building new coal plants like what China is doing. You have nat gas, the primary solution that we see as the winner in the near and medium term. And then you have nuclear, also a beneficiary there in administration that's very pro-nuclear. All of that rolls up into really a re-anchoring around physical, which we have not seen in at least 40 years. So that to us says that GE Vernova needs to really be a core holding in any large cap growth portfolio. And we had that as last year's winner, which returned 88% for our top pick. And we're choosing it again because even though the stock has run quite a bit, we actually think the opportunity is still being underappreciated, particularly in terms of the scale of the new orders, but also the service contracts that layer on top of that and the switchgear that needs to be associated with all of that. So when we look at that together, we see a very bullish outlook for GE Vernova.
Jed, let's just stay on GE Vernova for a second. I can tell you, and I know this is not the case, but people hear GE, they're still thinking this company's making light bulbs and appliances. You and I both know that's not the case. They've split the company up. Next year, what are some of the biggest catalysts for this company, GE Vernova?
Yeah, I mean, I think continuation of the current trends, which is largely, so this quarter alone, they will have usurped all of last year's orders for natural gas turbines. 50% of all electrons, if you exclude China, in the world are generated through a GE turbine. And so as you take that gas, you have simple cycle and combined cycle. And what we've seen so far is more of the simple cycle, shorter time frame to get up and running in the permitting. And we're going to start seeing the combined cycle, so this will generate a lot more power, start to roll through. They've quietly doubled capacity from 50 to 100 now. And then, as I said before, on that power side of the business, by the way, you've also seen pricing that's tripled over the past 3 years from $800 a kilowatt to now $2,400, $2,500. But none of that really incorporates the service side. So each one of those new turbines is going to come with a service agreement. Think of this as like the agreement you have with if you have a natural gas furnace to heat your home, or even some people have oil furnaces. They'll usually come with a service contract to make sure it's running at optimum levels. Well, these big electricity, combined cycle turbines, they also come with those service contracts. And so but the first outage isn't for 8 to 10 years. And so you start to build a recurring revenue model that's all very accretive to the overall business. On top of that, they're rolling in an acquisition of Prolec, which is not in the models, which will come in 26. And all of these plants are going to require switchgear, which is in the electrification business. And the fact that the wind business is sucking wind is actually a good thing for profitability for the overall business, because that was the laggard and was dilutive. So we see the trends of both electrification and power being the driver for GE Vernova.
I know you also cover Tesla as seen through the prism of energy. But this year, I've hopped on every single Tesla earnings call. I hear Elon talking about AI, talking about cars, talking about driverless cars. Should Tesla still be viewed as a good play on energy? And what is the state of their energy business at this point?
Well, I think Tesla is being viewed more and more on autonomy and energy. And I think with Elon's pay package, the expectations have shifted to, what are they going to grow organically, and what will they need to fold in inorganically? And I think that's what's driving some of the expectations, as well as is part of that automation, both with automated vehicles and going to driverless down in Austin now, also moving to Optimus in terms of the robot and what that might mean. What is happening there is there's really a de-emphasis on the auto business, which we value in some of the parts analysis that we've published. It really only about $30 to $40 per share in that business. So what you've seen is a pivot where Tesla was looked upon as an EV company, and through the transition, you've really seen energy grow, also equal or probably a little bit worth more than just the auto business. And then really autonomy makes up over 70% of that value today.
Coming up, we have our latest edition of Goodbye or Goodbye. Next, don't go anywhere. Welcome to Goodbye or Goodbye. Our goal, to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Brian, great to see you, my friend, as always. Let's start with what you like, Brian. And this is Intel. You got to buy on this name. Remarkable move for it. It's up 80% this year, Brian. You say, you know what, you stick with it. It's still a buy. Let's go through the reasons why. One, piling up investments. What do you mean?
Yeah, when you look at the combination of the $8 billion they got from the U.S. government through the Chips and Science Act, then another $5 billion from NVIDIA and $2 billion from SoftBank. This is really recognizing their leadership as the biggest manufacturer of chips inside the U.S., and these investments reflect that their leadership will continue.
Second reason, you say this is a smart place to commit capital, boost for future revenues.
Yeah, so all the capital that they're getting as investments is going to help them diversify their product lineup. So not just the simple chips that they used for the automotive segment for a long time. Now they're going to get into the AI infrastructure race, help them innovate, design new products, and really participate in that build out.
Third reason, market share gains with AI.
Already getting it done. They have a big order from Supermicro where they're using the new processor, the Xeon 6 processor designed by Intel, deploying it for their database management and enterprise application business already.
All right, so I'm convinced, Brian. I'm ready to commit capital. Before I do, what are the downside risks I got to think about?
There have been delays in manufacturing for Intel. Their new 7-nanometer chip is delayed, and that is causing them to lose market share in the hardware segment of their business, so really directed towards PCs. So this is a place where they do need to accelerate and catch up and get these new products online.
And you would obviously argue, all right, it's made an 80% move, but you must think valuation is still attractive.
Yeah, absolutely. I mean, it's all about productive capital going forward. And as they grow their market share and innovate and participate, again, already being the leader in U.S. manufacturing-based semiconductors, I think the road for future gains is still paved really, really well.
All right, so buy Intel. Let's go to a name you're not so enthusiastic about. That would be Netflix. Now, this one's up about 7% this year. Most on the street are bullish. You're not, Brian. Let's go through those reasons. Growing competitive landscape.
Yeah, absolutely. So Netflix had been, by a wide margin, the U.S. market share leader, but they just got passed by Amazon. Amazon Prime Video, now 22% market share in the U.S., and Netflix down to 21%. So you're seeing the competitive wave here domestically is catching up with them. Hot on their heels, you've got Paramount and obviously Disney+. Some other names out there, really the race for subscriptions and eyeballs, it's just getting hotter and hotter.
Now, because we're talking about this competitive landscape, we got to bring up WBD, because the board just says, hey, they still favor this Netflix deal. If that happens, Brian, doesn't that mean Netflix picks up a library, it picks up a lot of sought after IP? What do you think about that?
Yeah, that definitely helps them in the short term. There's a little bit of a caffeine buzz there where you get a little bit more viewership and you also get a nice library in there. But at the same time, their future debt obligations are one of the things that are concerning. How much of that would weave into that new WB process, right? We know that Discovery is going to go somewhere else. But how much more are they going to have to commit to continuing that line of intellectual property when they're already backlogged with a lot of debt?
Second reason, you say Netflix is one to avoid: concerning spending obligations.
Yeah, just their content future obligations is $21 billion. When you add to that their long-term debt obligations that are on the balance sheet, over $14 billion, you can start to see where servicing this debt is really going to draw cash flow away from earnings. And so we think that if subscribers are going to top off in the next year or so, this is a long-term view, but also cash flow is going to be declining as it services the debt, you can see how this leads to lower earning picture in the next year or two.
And a final reason you're not interested in Netflix: debt load, downside risk.
Yeah, really, it's all about the weight, that combination of the payments that they're going to have to make to service that future debt. Interest rates are coming down, but they're kind of stuck where they brought this debt on the balance sheet about a year or two ago. So they're kind of in a high rate environment on the debt that they currently have. They could try and refinance that, they could try and restructure it, but it is one of those things that concerns us about future cash flow.
All right, so you're a Netflix skeptic, Brian. Where could you be wrong?
Well, they are growing their ad business. And if that continues to accelerate, that might be the offset to the spend in terms of financing that they're looking for when the debt comes back into the balance sheet. So it is one of those things where they could use AI innovation to continue to drive ad business and hopefully lower the cost of future content as well.
All right, buy Intel, the man says, avoid Netflix. Brian, thank you, sir. Appreciate it. And thank you all for watching. Up next, we're going to speak to a marketing expert about the biggest brand moments from 2025 that investors can't ignore. That's coming up next. As options trading activity ticks up, Yahoo Finance's Jared Blickery is breaking down the need to know basics before jumping in. Jared.
Thank you, Josh. As this record-breaking year for options trading draws to a close, we're helping you add some proven strategies to your options toolkit. The other day, we broke down covered calls, which generate income on a stock you already own. And in today's options playbook, sponsored by Tasty Trade, we're explaining its cousin, the cash-secured put, which generates income for you and can help you leg into a stock that you'd like to own. So let's define it. A cash-secured put is when you sell a put option and you set aside enough cash to buy 100 shares at the strike price if you're assigned. In plain English, you're getting paid today to make a promise. If the stock drops to a certain level by a certain date, you're going to buy it there. The upside of this trade is you earn premium income up front, and we got some pros and cons here. Plus, you're potentially buying a stock at a lower net price because the premium you collect effectively lowers your total cost of buying the stock. Don't worry, we're going to review the simple math in a minute. The downside, though, is this setup does not make risk disappear. If the stock falls hard, losses can still add up because you own the shares. And because it's cash secured, your cash is tied up until expiration or until you close the trade. So here's how this can work with a big liquid name like Microsoft. And this is just an example, just not a trade recommendation. So let's check out a chart that's going to be year-to-date of Microsoft, and we're going to be adding the 200-day moving average, which you can see in blue right here. Now you can see that the current price is right above the average, which is just above the $470 price level. And this is the second time in a month that this average is being tested. So here's a simple bet. We're bullish, and we think that the 470 level holds into mid-January. But if the price of Microsoft is below that at the end of options expiration, we're also happy to own that stock from 470 in that case. Now to the trade details. And we have a pretty good summary here, but bear with me through all the numbers and text. We're looking at the January 16, 2026 monthly options. And this example is selling the 470 put for about $9 per share. And let's translate that into human terms. Each options contract is for 100 shares. So when you sell that put, you immediately collect $9 times 100, or $900. That is your max profit on the trade. And if Microsoft is below 470 at expiration, you can be assigned, meaning that you buy 100 shares at $470 for $47,000 total. But because you already collected $9 per share in premium, your net cost basis would only be about $461 per share. So you're essentially saying, I'll get paid to wait, and if I have to buy, I'm buying at an effective discount to today's price. And yes, this is why it's called cash secured. You're setting aside the cash to pay for those shares if you end up owning them. And a quick note, because these are so-called American-style options, you can get assigned the shares at any time, regardless of where Microsoft is trading. But that is not the norm. Now let's show the profit and loss on this trade and show how it can vary with where Microsoft shares are trading at the end of options expiration. So first, notice that the main profit and loss line at the top is flat, and that's to the right of that 470 price, which is marked with a blue line right here. That's because your profit is capped. The most you can make is a premium you collected, about $900. If Microsoft rallies, that's great, but you don't make any more on this trade than that upfront premium. Then notice how that line starts to decline and slope down to the left to the left of that 470. That's because below 470, you're effectively on the hook to buy the shares at 470. So lower prices work against you. And finally, look at that dotted yellow line around 461. It's your break even. That's a price where the premium you collected has been fully used up. Above that, you're still net positive on the trade. Below that, you start taking losses that are the same as owning the stock. It's a simple trade in the end. A cash secured put is a great way to try to get paid while you wait, especially if you've got a stock that you'd be happy to own, but maybe at a lower price. Back to you, Josh.
All right, thank you, Jared. America's biggest banks are closing out 2025 in a position they haven't been in for years. Record stock prices, growing balance sheets, and what some executives are calling the most open regulatory environment since the financial crisis. For more, we're bringing in now Yahoo Finance banking reporter David Hollerith. David.
Hey, Josh. So last week, a number of large bank CEOs spoke at a Goldman Sachs financial services conference. And generally the takeaway from what they said and what we've seen this year and this week has been, another great year in the books for the banking sector. But for the biggest banks, it's kind of a unique position because two of them have kind of taken a more offensive position in setting like growth targets that they want to hit or profitability targets. Now, for a while, we've kind of always had one of the larger banks in some way having to deal with regulatory burden or something like that. And we're in a scenario now where all those banks are looking more at growth. A great example of this is JP Morgan Chase, which for years has been performing fairly well. They came out with an announcement about how they're going to increase their expenses by $10 billion next year. Now, we don't know the other side of that, how much revenue they're going to actually bring in yet. But a lot of that is pointed towards updating their credit card program and doing AI technological advancements, and then also adding to their strategic investments. So all that taken together has kind of been seen as a big move that a lot of other banks are going to be eager to follow in some way if they can. And so kind of the sentiment is that everybody is looking at their growth plans and trying to sort of reevaluate what they can do. The other side of this too is that the Trump administration has been very actively pushing for a deregulatory financial services industry, or a deregulated financial services industry compared to past years. And kind of what we're expecting now is that next year, there will, at least by the end of next year, as far as we know with estimates, there will be a lot of extra capital that banks will have that they will not need to hold. And that will mean too, they will have more money for growth, more capital for growth, as well as buybacks and potentially M&A.
While we have you, my friend, also a big IPO making headlines. What can you tell us about that?
Yeah, so the Medline IPO is it's kind of the last big one of the year, unless something crazy were to happen next week. But generally, after the U.S. government shut down, the conversation among bankers was that there were really 2 solid weeks left in the year to do an IPO listing, and that was this week and last week. Generally, as things kind of wind down with the holidays, companies don't want to try and go public. So a lot of the activity that was set for the end of the year is actually being pushed back to January. So it kind of bodes well for a firm start to next year, depending on whether or not the IPO window stays open with a bunch of other factors.
How did, by the way, we were talking about this off camera, how the government shutdown played into this? Yeah,
so effectively, the SEC has to be open for these IPOs to get approval, and they did come up with a workaround for that. But there were still some issues where if you hadn't done a certain amount of paperwork with your prospectus beforehand, you weren't really well timed to deliver during the government shutdown. So it was a lot easier for a lot of companies and a lot safer, honestly, for them just to hold off and wait until things were figured out.
Interesting. All right, David, thank you, sir. Appreciate it. Well, brands found themselves in the middle of some of the biggest cultural flashpoints of 2025. From value-driven boycotts to free speech controversies and even viral memes shaping marketing strategy. We're breaking down what we learned and what investors can look out for going into 2026. Joining me now, we got Marcus Collins, marketing professor at the University of Michigan Ross School of Business. Marcus, always great to see you. So let's dig right into this, Marcus. The trends you call out here in 2025. One is the politicization of the product. High level, Marcus. Walk us through that, explain it for us. What do you mean, and what are some examples?
Well, you think about Sydney Sweeney and American Eagle, Cracker Barrel changing their logo. It signals to the fact that what we consume is a signal of our cultural subscription, what we believe, where we subscribe our identity, and even our political affiliation. And as these commercial entities become politicized, our consumption becomes a vote on where we sit on each side of the aisle. Right. So what was normally considered something as trivial as what jeans you're wearing, because of the advertising, it now signals either you see it as a dog whistle for eugenics, or maybe it's just a double entendre on the word jeans. Which one is it? It all depends on who you are and how you see the world. It's not a benign consumption anymore. This is a way of saying who you are and where you sit on the political aisle.
One question, Marcus, I have, you're listening to this right now, and you're an investor. How does an investor try and distinguish between, Marcus, short-term drama, short-term outrage, versus, okay, hey, this is actually something longer term. I think maybe real structural brand damage is being made here that could result in real financial repercussions. I mean, American Eagle, you brought up, I think is an example where, listen, if you were an investor and you were watching these headlines and the pitchforks coming out on social media, maybe you got spooked, Marcus, but if you had gotten spooked and bailed, well, you miss out on a stock that jumped about 65% this year. It's up about 175% since the Sydney Sweeney ad came out. Any advice, Marcus, about how you try to distinguish these things?
You got to read the cultural tea leaves. Because with the Sydney Sweeney American Eagle debacle, while it was certainly controversial when it first happened, unfortunately, Sydney Sweeney actually took the biggest hit. Like all the movies, she had 3 movies that came out after this campaign launched, and they all tanked in the box office. And even her sort of space in the cultural zeitgeist has been tarnished. American Eagle kind of benefited from her getting the hit. So for an investor, you've got to be really, really close to this. You can't look at the activity on the surface. You got to get a sense of how is the culture, how are the people, how's the populace making meaning of these situations. Sure, on the surface, it looks like this is about like some racial tension that's happening. But at its core, people are making meaning. What do these brands mean? In the case of Sydney Sweeney, you had 2 brands at play. You had her, the actress, a personal brand. Then you had this denim brand known as American Eagle. And they kind of left this thing a little unscathed relative to Sydney Sweeney's position in all of it.
Marcus, here's another thing you call out, the cost of free speech. Walk us through that one.
Yeah, I mean, we saw with Jimmy Kimmel, his, being censored and essentially kicked off the air because of the political blowback of some comments he made about the execution of Charlie Kirk. And what we saw here is that there was so much political pressure on ABC of the Walt Disney Company to censor one of their most high-profile talent. And what we saw here is that while there is a want for control in this particular backdrop, in society, the zeitgeist still has a very strong affinity for freedom. And in all of these cultural happenings, these brand moments, it's really just a tension that we're at play with. With regards to Jimmy Kimmel, it's control versus free speech, right? With regards to Sydney Sweeney, American Eagle, this is about commerce and political identity. These things are constantly at odds with each other. And for investors, as well as for marketers, we have to find where we sit on that spectrum, because its impact and its result on business is pretty substantial, as we saw in this past year.
When a brand, Marcus, decides, okay, we're going to distance ourselves from this voice, I'm going to do that publicly, does that, Marcus, in your experience, how does that often end up for the brand? Does that decision, does that reduce risk, or does that often make everything worse?
It always depends. That's always the right answer in business. It depends. It really does depend. It depends on how convicted the company is in its beliefs and how it sees the world. Clearly, we saw that the Disney company was willing to sort of walk back its original stance of moving Jimmy Kimmel off the air once they got pushback and feedback from the audience. When it comes to making decisions, what I always tell brands, always this, is that make decisions based on conviction, not on convenience. Choose conviction over convenience every single time, because there's always going to be trade-offs either way. But at least the trade-offs that you make are in line with how you see the world as opposed to how you think things are going to play out.
Marcus, we're always lucky to have you on the show. Happy holidays, my friend.
Same to you. Appreciate you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.